Hello everyone and welcome to my morning report analysis videos on Friday 21st of December with me, Richard Penn, market analyst at Hantec Markets. There is still this air of risk aversion that's coming through the markets ever since the Fed meeting. Well, I mean, it's obviously been before the Fed meeting, but the Fed meeting didn't really help in any way at all. And the markets were certainly disappointed with what the FOMC decision was, and subsequently risk appetite has continued to fall quite sharply, and you can see that through volatility on the VIX, which is again sharply higher in the last sort of couple of sessions. S&P 500 itself has fallen significantly. Look at that, breaking down to multi-month lows, to 2018 lows, and it really is under pressure, and certainly the selling pressure continues to sort of run through European markets today, all of which are lower and showing little signs of stopping really. There had been an initial air of dollar correction that was coming through into the European session, but that's just unwound slightly as the euro has fallen back again. But certainly it looks as though the dollar is still under pressure following on from the Fed. You've got the yield curve which continues to flatten. 2-10 spread now back at 12 basis points. Yields don't look all that great, all supportive for any sort of dollar rally at the moment. So this is coming as the threat from Donald Trump is that there will be possible government shutdown if he doesn't get the funding that he wants for the building of the wall between US and Mexico on the border. So we're seeing the prospect of that also looming over sentiment today. So it's not all looking that great, and the prospects of a Santa Claus rally, yeah, they're not looking all that sharp either. So that's what we're seeing today. Now, in terms of data points, we've had a clutch of GD UK data. Quarterly GDP came in line with expectations, again for the third time of asking on Q3 at 0.6%. Little bit of an interesting move on the current account though. That was disappointing. Bigger than expected current account deficit there for Q3 as well, so that's not going to help sterling all that much. Into the afternoon we've got the GDP for the US, final reading for Q3 expected to again be reiterated at 3.5%, and then we're looking at the core PCE, which is expected to tick a slight amount higher in the on the year-on-year data, back to 1.9%. So a little bit of an improvement there in the inflation data, but still underneath the Fed's 2% target. Now, that takes me to my chance today, which is sterling Aussie, which has been on a bit of a tear recently. We've seen sterling outperforming to a mild extent, but more the fact that the Aussie has been under pressure. And this is sort of coming through on the sterling Aussie, which has now completed this near-term head and shoulders reversal. Look at the momentum indicators, RSI almost towards 60, that's two and a half months highs almost. MACD lines accelerating, stochastics accelerating. The breakout above 78.15 is a multi-week high. That completes the pattern. That sort of certainly suggests that we're going to continue higher within this Fibonacci retracement of the sell-off. 79.68 comes in as the next fib level of 50%, and then 61.8 is 81.50, and it certainly looks as though the November highs could come under test now. 80.65 and 80, if I can get the crosshair on it, 81.70 being that November high as well. So there is an improvement, and certainly the momentum indicators are with this one at the moment. You can see that with the consolidation early today or through yesterday, then breaking out once more. So you've got sort of basis of resistance around the breakout, 77.50, 77.10, today's low 77.70, and the breakout also the neckline at 78.15 being a basic support. So lots of levels there to look out for, but certainly I think the momentum indicators are behind the recovery in this one, and sterling against the Aussie is looking positive. So with that in mind, I wish you good luck in your trading, and I'll speak to you later.